I'm going to move on to what could Q3 earnings mean for stock indices. We've got the earnings releases starting on this week. It's an important period for stock indices, without doubt. We've got Delta Airlines kicking off the season tomorrow. I think the markets are probably waiting to see what the banks do. Or, they start on Friday, but stock indices have been under pressure since early September. But having said that, earnings expectations have risen. So it's a difficult one at the moment. Stocks have been hurt by higher interest rates, higher bond yields, and lower risk sentiment. You can see here the USA 30, what we call the Dow, on the 4-hour chart here. It's not been a great performer, particularly this last few weeks, last week or so. The USA 2000, this is what we call the Russell Index. This is the small cap stocks, the more value stocks rather than growth stocks. Pretty torrid time there as well. So the problem for the small and medium-sized businesses is that higher borrowing costs are eating into profit margins. We've also got higher unit labor costs, which moves into profit margins as well. So it's the other thing is that the bank lending criteria is tightening, so it's harder to get loans to actually expand your business, and this is beginning to show up in some of these sectors, if you like. So I think this environment of higher oil prices, higher borrowing costs, and a higher dollar is going to impact earnings at some point. Whether we get that in this quarter or not, I'm not sure. But if we look historically, then it's been a pretty tough situation when we've had these sort of things aligned before. So I think, earnings expectations have been rising for Q3 after a poor previous quarter. But with yields where they are and borrowing costs where they are, I'm not sure whether we're going to get what we expect. However, it seems that traders and investors aren't confident in this belief of some of these expectations as we've seen. So the potential for extra volatility across the stock indices is quite high going over the next 15 to 20 days. So just bear that in mind. The indices probably won't move as much as the individual sectors, but individual stocks particularly have got some real volatility in them coming up. I'll be very interested to hear what the CEOs of some of these companies have to say looking forward. And they're as important as the earnings headlines themselves. So I think the big focus this week will probably be on Friday when we get the big banks reporting. Now, with higher yields, you'd expect them to be doing quite well. But the problem is the front end of the yields where they borrow have gone nowhere, but the longer dated yields have gone up, and that's why they lend. So they've not done that well, on that basis. So we've got JP Morgan, Wells Fargo, and Citigroup starting on Friday. And then next week we get Bank of America, Morgan Stanley, and Goldman Sachs. I would expect, as we usually get, is JP Morgan to outperform. They are quite an exceptional bank. But traders will be looking out for how the challenges of a slowing economy and higher rates have impacted revenue. I think that's really important going forwards. And the extent of bad loans. Now, it seems that the consumer has moved from spending their savings, which have dried up, to credit card loans. But some of these are delinquent now. And so we're seeing some small businesses and retail customers having some delinquencies on borrowing. And I think that's going to be interesting to see if the banks highlight that for us. And certainly, as I said earlier, what the CEOs say about future earnings and potential and the direction of the US economy are going to be vitally important for investors as well. All of which will have a big say on the direction of stocks going forward. So a big couple of weeks for stock markets could impact the dollar, could impact all sorts of things. So looking forward, next week also sees companies from two other sectors start to report. And these are going to be really important from my perspective. Consumer giants like Johnson & Johnson, Procter & Gamble. These are consumer-facing businesses. And I think these consumer-linked companies could be sort of rather disappointed with the outlooks that they see coming. To me, it looks like the consumer is slowing down in the US. So as you can see here on the chart on the left here, this was from a Bloomberg survey. Consumer-linked companies face a sour outlook. Look at those percentages. 80% warn about profit and revenue trends, and that is big. So the consumer is really on 24/7 watch for me. And I think that the danger here is some of those companies are going to see some fairly strong headwinds ahead, and they may highlight that. So there could be real problems in that sector going forward. So the retail sector, particularly, looking vulnerable. The US 500 daily chart, there's a lot of big tech in there. So, we've held off that support. We've bounced quite nicely off 50% retracement. I think we saw, but this support is holding at the moment, but earnings could change that. But there is a lot of big tech in the S&P. So, those companies, if they're doing well still, will hold that up. But it's going to be an interesting week or 2 or 3. But you have to look at the tech sectors. Now, the tech giants like Netflix and Tesla, they start to report next Wednesday. The what we call the Magnificent Seven, the big techs, your Nvidias, your Amazons, Microsofts, etc. They've been dominating the index performance. They've been holding the S&P up. Now, look at this chart, bottom left here. This is a fascinating chart. The blue line is the Magnificent Seven stocks. These are the big boys. But look at the black line. This is the rest of them. So on a period from September 22 to now, they've done nothing. No increase at all. And in fact, a lot of the sectors are down. So it just shows you the narrowness of the rally that we've seen in the S&P based on 7 stocks. Now, in a stock that is built of 500 companies, that is pretty shocking. But they are huge companies, and they dominate the S&P at the moment. So they could continue to do so. So if you're looking to trade, maybe the S&P is not the indices for the index for you. Maybe look at the Tech 100, which is more specifically tech, or individual stocks. But for me, the US Tech 100 is in a bit of a range, as you can see here with that key support there from the 3rd of October, with that resistance back from July. And I think until we break that range, I think we're going to be a bit stuck. But these earnings numbers, could shift this quite substantially. But I think that's a fascinating view there, particularly that Magnificent Seven chart there, showing the difference between just a few stocks and the underlying S&P. So be careful that you're not trading the index when you should be trading individual stocks or a sector, because you're almost eradicating any potential profit in that for other things as well. So I think that's a really interesting snapshot. I do think there's going to be some volatility going ahead, and I think we have to trade accordingly going forwards.